In today's video, we're going over 8 misconceptions that are out there about Roth, and they're all listed right here. So make sure you stick around because we think Roth is important, so we don't want you to have the wrong impression or be confused about anything. So stick around. We'll be going over these 8 misconceptions coming up next. Hey, this is Mel Stubbs. I'm a financial planner at Christy Capital Management, where we're helping federal employees prepare for retirement. If you need individualized help and you want to work with somebody that knows your federal system, go to christycapital.com and click Talk to an Advisor. The first question we're going to answer is Roth inherently better? Now, with comparing Roth with traditional, it all comes down to the tax rate. If you contribute an equal amount of before-tax money to traditional versus an equal amount of after-tax money, so a reduced amount for taxes, to Roth, and they're invested in the same investment with the same return, and the tax rate remains the same the entire time, you will end up with the same amount of money after tax. Remember, after tax. So the traditional will look bigger, but when you apply the tax to it later, it will equal Roth. So whether you pay up front or you pay it later, as long as the tax rate is exactly the same in both scenarios, you have the same amount of after-tax money. So that is probably not inherently better. What makes it better is if you think tax rates are going to get worse in the future. Because when tax rates are exactly the same, the traditional, the Roth, it doesn't matter. But there are lots of people out there like David Walker, who's a former Comptroller General for the US government from 1998 to 2008, who says tax rates have to go up in the future. He says unless we begin to get our fiscal house in order, there's simply no other way to handle our ever-mounting debt burden except by doubling taxes over time. So if tax rates go up in the future, then Roth would be better because you would have paid taxes now at the presumed lower rates. So is Roth inherently better? No. If you think tax rates are going to be higher in the future, would that make Roth better? Yes, it would. The second misconception is some people say as long as you convert something, then you're fine. Like that's enough. Something is better than nothing. Well, I guess by definition, if you think Roth is beneficial, then doing some of it is better than doing none of it. But much like diet and exercise, to be healthier, is doing a tad bit of exercise enough? Does that make everything fine? I mean, that would probably be better than nothing, but if you're doing proper planning, you could come up with a diet and an exercise routine that would be ideal. You could argue the same thing about tax planning with your retirement fund. If you think taxes are going to be lower for you in the future, then it would be wise to leave all of your retirement money traditional and wait to pay taxes later at the lower rate. If you think tax rates are going to be higher in the future, it could be wise to shift as much traditional money as you could, even to the point of moving all of your money to Roth. If you're not sure what tax rates are going to be, then do some Roth conversions, but not all, and you've made a conscientious decision to diversify and not put all your eggs in one tax basket. That sounds like a good plan. But just Roth converting a little bit just to say you did it, that's not the most conscientious planning that you could do for your retirement. Another misconception I hear is that should the next generation determine the conversion amount? I think what is meant by this is you have to pay taxes in order to do a Roth conversion. If you've determined that you're not going to spend all your money and it's going to be your beneficiaries one day, should you look to see what tax bracket they're in? If your tax bracket is potentially better than what theirs will be, it could make sense to do some Roth conversions at the lower rate than what they would have to do later. Now that's a decision for you. I would say around half the people that we talk to are worried about this and would like to pay taxes at the lower rate, even if it means that they pay it now instead of their children. I would say the other half the people we talk to are of the opinion that their kids will get what they get and they can handle their own taxes. Is this something that everybody should figure out? Well, it depends on you. Is that going the extra mile with planning? It probably is, but it's not vital. Another misconception is that you have to wait 5 years to touch your conversions. Now, there are some nuances with this question. With Roth IRAs, you have to have had a Roth IRA account for 5 years, and you need to be over the age of 59 and a half to touch your gains. If you are over the age of 59 and a half and you do a Roth conversion, you can access the converted amount immediately because you're over 59 and a half. If you've not had the IRA for 5 years, you would have to wait 5 years to touch the gains, but since you're over 59 and a half, you could touch the converted amount immediately. However, if you're under the age of 59 and a half and you do a conversion, then you have to wait 5 years to touch the converted amount. Think about it this way. The way the tax law is written is that if you have a traditional IRA and you access that prior to 59.5, you owe a 10% penalty. You owe taxes and the 10% penalty. If you Roth convert it, you would pay taxes, and if you were allowed to then access it immediately, you could end up taking distributions from traditional IRA and avoiding the 10% penalty in essence. The IRS does not like that. So their way around this is if you're under 59.5, you can do a conversion, but you're gonna have to wait 5 years until you can touch it, unless you're over 59.5. For example, you do a Roth conversion at age 50, and you have to wait until age 55 to access the converted amount. You do a Roth conversion when you're 57 years old, then you can access it at 59.5. Another misconception is that conversions only make sense if you pay taxes with funds that are outside of the IRA. So if you want to make your conversion the most efficient that it can be, by getting the most money to Roth that you can, you would pay taxes from an outside source, not the IRA. Let's say you want to do a $100,000 Roth conversion. You would like all $100,000 to show up in your Roth account, then you're going to have to pay taxes from another source. The tax amount will be owed and you'll have to pay with other money. Alternatively, you could do a $100,000 conversion, and let's say, for instance, you pay 22% federal tax, 5% state tax, so $27,000 goes to taxes and only $73,000 shows up in the Roth account. In both instances, you had a $100,000 taxable event and you'll get a 1099 for $100,000. But in one instance, all $100,000 landed in the Roth account. And in the other instance, only $73,000 showed up in the Roth account. If your goal is to get the most money that you can to Roth, then pay the taxes from outside sources. Maybe that can make sense. But lots of people that we help, they don't have money sitting around earmarked to pay taxes. And so we do lots of conversions where we withhold taxes from the conversion to get the money over to Roth. To say that it only makes sense for you to do a Roth conversion when you pay from outside sources, I would say that's not correct. If you have that option to pay from outside sources, that could be better, but it still comes down to what do you think the tax rates will be now and in the future. If you believe today's rate is lower, then paying the taxes from the IRA money can still make sense. Let's go ahead and throw in our disclaimer to check with your financial professional or CPA to make sure that you're doing what's appropriate for you and your situation. Another misconception, I can pay the conversion tax next April. In our example of the $100,000 conversion, I'll just pay the taxes from another source, and I'm gonna wait till next April to do it, to pay the taxes then. Is that possible? Yes. Can the IRS get mad at you? Yes, they can. Here's what I mean by that. So the IRS requires quarterly tax payments from people who have not withheld enough. The IRS says that if you owe $1,000 or more federal taxes this year, even after accounting for withholding or refundable credit. Also, your withholding or non-refundable credit will cover less than 90% of your tax liability for this year, or 100% of your tax liability for last year, whichever is smaller. The threshold of 110% if your adjusted gross income last year was more than $150,000 married filing jointly, or $75,000 for married filing separately. So usually if you're doing a large conversion, in our earlier example, doing a $100,000 Roth conversion, where you're going to owe $22,000 of federal taxes in our example, and you choose to not pay it till next April, there's a good chance that you will not have withheld enough money from your income, and if you're still working, or from your pension if you're retired, and it will cause you to have to make quarterly payments. That can be a hassle. There's also penalties that you could owe if you don't pay it in time. So the way around this is to either withhold the money from your IRA money at the time of conversion, or to go ahead and start making quarterly payments so that when you do your taxes, you have withheld enough from your withholdings on your W-2, your pension, or from the quarterly payments. If the rules sound overly confusing, then you probably don't want to wait till next April. The next misconception is that you must convert everything. Like if I got to do it, I got to do all of it. I know we sort of talked about that earlier, how doing just a little bit and saying that's enough probably isn't the best planning. But for some people, Roth converting all of it might be exactly what they need to do. As we're working with people, we talk over how charitably minded they are. If they are actively giving to their church or other charities, then we may want to do some math to help them. Right now, the standard deduction in 2024 is $14,600. For someone single, it's $29,200 for married filing jointly. If you're charitably giving money away and your itemized deductions are not in excess of the standard deduction amount, then you are taking the standard deduction and in essence not really getting to write off your charitable giving. But at age 70 and a half, you can do a qualified charitable distribution or a QCD from your IRA where you give directly to the charity and it's not taxed. In this case, you can take the standard deduction and take the write-off for charitable donation. So instead of writing a check to your church for $5,000 using after-tax money from your checking account, you could do a qualified charitable distribution sent from your IRA to your church for $5,000, and you don't pay tax on the $5,000. You get to take your standard deduction, and you don't pay taxes on that $5,000 ordinarily taxable distribution. Now, please work with your tax preparer and let them know that this distribution was a qualified charitable distribution, because there are things that need to be done correctly on your tax return to make sure that you get the deduction or the credit or the whatever the fancy lingo is called, just to make sure you don't pay taxes on it. Let's say you're working with Fidelity and they send you a 1099. The 1099 doesn't say anything on there about, hey, this is a qualified charitable distribution. So you need to have the proof turning it into your accountant to have them do it correctly. But if this is you and you're charitably minded, you want to take advantage of this deduction by taking your standard deduction and using a qualified charitable distribution, you can only do a QCD from traditional IRA money. You can't do it from TSP. So maybe for your situation, you convert 80% of your money, but maybe you leave back, I don't know, $150,000 of traditional IRA so that you can do charitable giving and not pay taxes on it. If you want to do that, you wouldn't want to have all Roth and zero traditional, because you can only do QCDs from traditional IRAs. The last misconception is that you need to be done with your conversions before your required minimum distributions start. So depending on when you were born, and you can check right here, your RMD is either going to start at age 73 or 75. You only have to take RMDs from your traditional accounts like traditional TSP, traditional IRAs. This is where the government forces you to take a distribution and you get taxed on it, and it has to leave the tax deferred account and go into a checking account or some other taxable account. You're losing the tax benefit because they force you to take it out. In a Roth IRA, you don't have RMDs. So people are trying to get the money shifted over so that they don't have any required minimum distributions. Let's say in your case, your IRA is so large that you can't Roth convert effectively fast enough to have a zero balance by the time you hit your RMD age. Does that mean it's not worth Roth converting? I would argue that if you believe taxes are going up, then mathematically it makes sense to pay the taxes now. We help people by doing tax bracket planning to see how much can convert in the 22% bracket, let's say. How much can you convert if we go up to the 24% bracket? How much can we convert if we go to the 32% bracket? Let's just say in this case, you're comfortable with paying 24%, but you're not comfortable paying 32%. That will limit you each year because you got to stop at the top of that 24% bracket. If you do this type of planning, you may show up at your RMD age and you haven't converted everything. It's not the end of the world. You will have to take a required minimum distribution based on your December 31st balance in your traditional account, which hopefully will be lower since you've been doing years and years of converting. You cannot Roth convert your RMD. You have to take that distribution, put it in your checking account or another taxable account, but you can continue Roth converting if you want to. So let's say you must take a $20,000 RMD and you want to do a $100,000 Roth conversion. You cannot Roth convert the $20,000. There'll be a 1099 for the $20,000 distribution that you're forced to take. And then if you choose to do a $100,000 conversion, there'll be another 1099 for $100,000 for doing the conversion. Now in reality, you'll probably get one 1099 for $120,000. At whatever point you get your traditional money to zero, then all required minimum distributions would stop. In a perfect world, if you want to Roth convert everything, you would have it done by the time you showed up at your RMD age. And that sounds great, but we don't live in a perfect world. If Roth converting makes sense for you, and you can't get it done by your RMD age, it's not the end of the world. Something is better than nothing, and you can keep implementing your strategy until you convert the total amount that you want to. Hopefully this video has helped. If you realize that you maybe need to do tax planning, but you don't understand all the details, but you know you should, and you want to work with somebody that understands these things and also understands your federal retirement, reach out to us at christycapital.com. We would love to ease your mind so that you know you got tax planning being handled with your retirement plan. If you want to check out another video, here's 4 reasons to avoid traditional TSP. My name is Mel Stubbs. Thanks for tuning in. Reach out to us. We'd love to hear from you. See you on the next video.